Hey traders, Jason here from Leavitt Brothers. Happy Wednesday. Today I'm going to talk about my favorite breadth indicators. Before I get started, quick reminder, I'll be speaking online for the Money Show tomorrow. So there's a link below where you can register. All right, so let's get on with this video. What is a breadth indicator? Okay, a breadth indicator measures the number of stocks within a group that meet a certain criteria as opposed to just looking at the group chart or an index chart. Okay, for example, we might look at the S&P 500 and ask the question, is it trading above its 50-day moving average? Okay, measuring the breadth would involve measuring how many stocks in the S&P 500 meet that same criteria. Okay, so instead of just looking at the surface, is the S&P above its 50? I'm going to look beneath the surface and see how many members of a group meet this criteria. Okay, so since there's no end to how you can analyze an individual group or index, because there's just so many indicators and so many parameters on those indicators, there are literally unlimited number of breadth indicators. So in this video, I'm going to discuss my favorite for gauging the overall market. All right. So my favorite breadth indicators are the advanced decline line, which I look at both with moving averages and the cumulative. Stocks above moving averages. Okay, these are the number of stocks moving that are above a certain moving average. I like to look at the 20 and 50. And then the high-low. This is the number of stocks making a high versus number of stocks making a new low. And I will look at the 20 and 50. So I'm going to go through each one of these relatively briefly because I don't want this video to be too long, and you'll get a good overview of what my top breadth indicators are. All right, so here's S&P 500 up top. This is going to be the advanced decline line. What I have here is the 10-day, 50-day, and 200-day moving average of the advanced decline line. Okay, so for near term and looking out a few weeks, I like to look at the 10-day moving average of the advanced decline line. I want to confirm strength. You tend to get like oscillations above zero. Okay, and that's a sign of strength. Okay, the market expands and then it contracts a little bit, expands, and as long as the 10-day stays mostly above zero, you're in good shape. Okay, there are brief dips below zero. Okay, like this, which is nothing to be concerned about. It's perfectly normal. The market rallies, then it pulls back, then it rallies. So brief dips below are perfectly fine. It's bigger dips below, as you can see right here, that suggest something worse is going on. Okay, another thing I look at is divergences. So when the market goes up and you get a divergence, so you can see in green, you can see the divergences where market moved up. Hard to see the divergence because the S&P 500 is so squished here. And the advanced decline, 10-day moving average of the advanced decline line moves down. That's a divergence that usually tells you that like negative energy is building, and eventually and pretty soon after, like within a few weeks, the market's going to top and come down. It doesn't have to come down hard. It's just going to probably rotate down. Okay, so and then finally, another thing I'll look at is just the absolute print. So you can see here, like a really high print is a sign of strength, and strength typically leads to more strength. Okay, so a high print says market's doing really well. Even if there is a pullback in the near term, the strength is usually going to continue. And since tops typically don't form until you get a divergence, the fact that you get a high print tells you that you're probably at least 2 to 4 weeks away from any type of top, because it's just going to take time. So like right now, you can look at this and say, this thing has come, there was a top here, and even if a divergence was going to form, this would come down and then this would come back up and put in a lower high and something like this, and a divergence would form. So we would, the market could press higher while we get a divergence, and then it would, and this would take a couple weeks to form. So high prints are a sign of strength, and you want to be on the right side of the market there. Now, backing up, I'll look at the 50-day moving average. I get most of my signals from the 10-day, but I'll look at the 50 and just to get some confirmation. And you can see here, when the 10-day oscillates up and down, when you get dips below here, notice that the 50-day didn't really go down much, cycled down, but not much. So that tells you that in the near term, like the 10-day will tell you that we have a dip within an uptrend, but then the 50-day will tell us that the uptrend remains in place. Okay? So near term, more longer term, And you'll see here, like back in February, March, where we got a move down here. Notice the 50-day like dropped really hard, really fast, which was worse than all these other previous prints. Okay, so as the 10-day cycles up and down, tells us expansion, contraction, expansion, contraction. As long as the 50-day stays steady above zero, then you know that these dips here are just dips within uptrends, and you could buy them. Then looking at the 200, I actually don't look at the 200 that much. I have it up on my screen. I look at it when I look at the, when I analyze these indicators, I look at it. But the reality is I just don't do anything with it because it just takes too long for anything to really signal. You can see this, right here, you had a divergence form, but it took so long that like I don't know what to do with that. And then over here, if you look at when it gets back above a key level, I'm not sure why I drew that there. All right, I'm gonna have to look at this. But when it broke out here, okay, by the time it broke out here, the market was already up to here. So if you waited, it's just too long. So I have it up on my screen, but the reality is I don't really use it. But 10-day, 50-day, I definitely do use. All right, next chart is the cumulative of the AD line. Okay, let's look at the bottom here. It's the cumulative with the 50-day moving average. There's two things I look for. Number one, is it like just trending up above the uptrending 50? That's a sign of strength when it takes out, and when the market dips here and dips here. If you just get a dip to the 50 and a dip to the 50, that's just a normal pullback within an uptrend. But when you get a move below the 50 and it gets kind of trapped down there, that's when you get bigger moves down. Okay, so it's the first thing I look at is just the trend of it relative to the 50. Now you also get divergences that form. Okay, so if the market pushes higher high and then you get a lower high here, that's something to look out for. Okay, and recently I've started looking at it with a Bollinger Band. Bollinger Band, the center band is just the 20-day moving average instead of the 50. And you can just see it. And I started looking at it because it seems to be in sync with the band. You can see how it got rejected here, moved above, rejected by the top band, middle band, top band, middle band. So it has decent activity around the bands. So I started looking at that recently, but mostly I look at with relative to the 50 to verify trend and warn of possible trend changes. All right, next up, this is the Russell. This is the number of stocks. I'm using the Russell 3000. Number of stocks in the Russell 3000 above the 20-day moving average. Okay, so what I have here in blue, right here is the S&P 500, and then all these black ticks are the actual readings from the indicator, and then down below is the 5-day, is the 5-period moving average. Okay, so I want high prints tell us that market's healthy. It tells you that a lot of stocks are trading above a certain moving average. Obviously, that means breadth is good, and good breadth tends to last a while. I look for divergences. Okay, so for example, you have a divergence here. Now, divergences at a high level don't mean much just because like you're still getting a really high print, so I tend to ignore those. But divergences at a lower level, like right here, which coincided with that top. You have a divergence right here, which coincided with this top. And then you had a divergence here, which of course coincided with this top. So a divergence at a high level isn't very meaningful, but when that second hump is at a much lower level, that's meaningful, and that's when you get a top. So when you get a high print like we have right now, if we need a divergence in order for the market to top, then it's gonna, this is gonna kind of come down, and then it's gonna come up and do a lower high, and that's gonna take a month or two to form. So high prints tell you that even if you get a dip in the near term, those dips are probably gonna get bought, and you're gonna continue up. And it's not until you get a divergence at a lower level that you run into trouble. All right, so next chart is similar. It's actually the same thing, except instead of asking how many stocks are above the 20-day moving average, I'm asking how many are above the 50-day moving average. I use it the exact same way. Okay, high prints are a sign of strength. Strength tends to beget more strength. Divergences take a little while to form. So when you get a high print, you still have a month or two before you run into trouble. I also look for divergences at high levels. So you get higher high here, lower high here. Second hump is at a lower level. Same thing as we ran up here. Okay, but you'll notice that these divergences take like 2 months to form. So when you get a high print, sign of strength, probably going to continue. Even if you get a dip in the near term, the fact that we got a high print tells you breadth was really good. And then, so you're most likely to get, the market is most likely to get bought up when it dips. All right, next is this, the high low. Okay, so this asks how many stocks are trading at a certain high versus a certain low. So the 1 month high low is how many stocks are trading at a 1 month high versus the number of stocks trading at a 1 month low. Okay, and you can look at this at various time frames as I'm about to do. You tend to want to get decent prints here at a decent level. High prints, again, are a sign of strength. Lots of stocks at a 1 month high versus 1 month low. Divergences offer warnings. Okay. So you have, to kind of give an example here, we had a divergence here. This moved up, divergence there, and divergence there. Okay, so again, high prints are really good, sign of strength, most likely going to continue. Market tends to not top until you get a divergence. Okay, but divergences take a couple weeks to form. So when you get a high print, you can be confident that any weakness in the near term will eventually get bought. And then it's not until you get a divergence where that second or third hump is down at a lower level, in this case 0, that you actually run into trouble. All right, last chart, same exact thing, except instead of 1 month high low, I do a 3 month high low. I analyze it the exact same way. High prints are a sign of strength, broad-based strength, lots of stocks participating, stock market not being dragged higher by a small number of stocks. There's lots of participation, and then divergences offer warnings. Okay, and you can see that when the market trends, up, you get just the 5-day moving average just kind of trends up. Not just trends, but it maintains a decent level above 0. Brief dips below are perfectly fine. But divergences warn that trouble is brewing, and then if you get a bigger move down, as we got here, that's a warning that something much worse is happening. Okay, so thanks for listening. This is just a brief overview. There are a lot of different breadth indicators you can use. If you want more details on how I use this, how it's kind of syncs up with how I trade and such, check out my mini masterclass in trading at the link below this video. Okay, again, thanks for listening, and I'll see you next time.